We are breaking into question time to bring you the latest decision on rates from the Reserve Bank. It is about to hand down that decision, its second of the year. Markets and economists are broadly expecting rates will stay on hold this month. And we have our business team on hand for the decision. David Taylor will join us from the Reserve Bank with his analysis, and Alicia Barry is here with me in the studio. Alicia, let's start with you. No one really is expecting any move, are they?
No. There may be some outliers that haven't been counted in a survey somewhere, but really broadly the expectation is that rates will stay on hold at 4.35%, where they've been since November last year. Of the economists surveyed by Refinitiv, the financial services firm, 40 out of 40 think that rates will stay on hold, and in fact 99.2% of market bet now that rates will stay on hold, with just 0.8% chance of a rate cut. So it's a pretty done deal that we will see rates on hold today, and it will be a big shock to the markets and economists if we do see any move.
Let's go to our business reporter, David Taylor, who is outside the Reserve Bank in Sydney. Hi, David. So no move, but what factors will the Reserve Bank be considering today?
Yeah, g'day, Roz. Look, I think expect to hear terms like inflationary expectations and expect to see statements including things like sticky inflation and needing to go that extra mile to make sure that inflation returns to the Reserve Bank's target range of 2 and 3%. The Reserve Bank's got a tricky job on its hand because inflation now sits above the Reserve Bank's target band, and it needs to keep interest rates in a restrictive stance to make it difficult for shoppers to be able to pay off their mortgage or rent and spend, and that gets inflation down. It's just not going down to where the Reserve Bank feels comfortable that the economy can move along in a way that won't cause any disruption for anyone. So in terms of that, if the emphasis is on the interest rate, cash rate remaining the same, but there is a chance of another rate hike, if things move against the Reserve Bank, then that'll all be about the Reserve Bank being worried about inflation getting ahead of where it wants it to be. And that might mean that it doesn't achieve the inflation rate of between 2 and 3% by next year or the year after.
We've got about 20 seconds to go before we hit 2:30 and that decision comes. But we talked about rates being left on hold, possible rate cut. But of course, the last time we were in this position, last time the Reserve was making this decision, it was still it's at a tightening bias, David. Yeah,
indeed. And I think every single borrower wants to get some sense of when interest rates...
And then cut away from you because Alicia has just got the decision now, Alicia.
Yeah, no surprises, as expected, on hold. I suppose that does come as welcome news to those who are paying a mortgage or have large debt burdens, because interest rates certainly haven't gone up, but they are still at, as David was saying, restrictive levels, at least in an historical context. So 4.35%, the cash rate is on hold, where it's been since November last year. I will bring in Chief Economist at EY Oceania, Sherelle Murphy, who is in our Canberra studio. Sherelle Murphy, thank you for joining us. Now, of course, no surprises today, but there wasn't expected to be.
No, that's right, Alicia. It would have been a shock had we seen a move today. And that's for good reason, because clearly the Reserve Bank is fairly happy with the fact that the economy is slowing down, but neither does it have reason to think that it's slowing down so far that it would have to reverse course. So still seeing some of the impact of last year's rate hikes flowing through the economy. That hasn't finished yet. And at the same time, we're seeing some of the impact on that on inflation, exactly what it wants to see. Inflation is kind of starting to come down, but the unemployment rate remains fairly stable and fairly low. That's also welcome. So it all adds up to a Reserve Bank that's going to be happy sitting pat for the moment.
And what's going to be key for the Reserve Bank ahead of the next meeting in May?
So yes, ahead of that next meeting, which is, around about 6 weeks away, we're going to see the first quarter CPI data. Now that's going to be really important because it sort of it gives it the biggest picture we can see on inflation. The monthly data is useful in the sense, but it's that quarterly number that they're going to want to see. Now at the moment, we do expect that inflation will kind of continue to sort of move down, but very slowly. So it's going to have to see something outside of that range for it to get particularly worried if it's on the upside. But of course, if it comes down faster than expected, that may open the door to rate cuts sooner than the last part of this year.
And there's been a lot of talk about the last mile of inflation. The last bit, getting it back to target, is proving very difficult. And the RBA today has said that returning inflation to target in a reasonable time frame remains uncertain, and the board isn't ruling in anything or ruling out anything. I mean, when do you see interest rate cuts coming?
I think it is certainly possible that we get them by the end of the year, but as the Reserve Bank itself has noted, it is difficult to kind of get that last part of inflation down to the 2 to 3% target band. So at the moment on the quarterly numbers, it's standing at 4.1. It needs to see it below 3% to be comfortable in its forecasts before it could even contemplate putting rates down. Now, there's a lot of things holding inflation up at the moment. We think about rents in particular. They are moving forward way too high for the Reserve Bank's liking. There's other aspects of services such as insurance, which are running very strongly at 15-16% annual rate at the moment. Some service prices are certainly starting to fall down, and also goods prices have definitely come right back as a lot of the problems that we saw with those in the COVID period have evaporated. But you certainly couldn't be sure that the economy doesn't still have enough froth in it, that it's keeping those prices higher than the Reserve Bank would like. So bottom line, I think it's going to have to see a lot more evidence that inflation is taming, and it is very possible that we don't see a rate cut this year at all.
I mean, we did see some announcements around reductions in power prices announced today. Do you think that will be welcomed by the RBA?
Certainly it will, and it will definitely feed in for the consumer. Prices will definitely be lower in that sense. But of course, the CPI is made up of many different goods and services. And so really it's the combination of all of those together that matter. No one price, unfortunately, is going to give the Reserve Bank enough reason to cut rates.
Certainly, the RBA appears to be still walking the line. Sherelle Murphy, thank you so much for your time. Appreciate it.
Pleasure.
And Rose, as Sherelle was sort of saying, the RBA may not cut interest rates this year. As I said, it didn't rule anything in or out, so it's walking the line and really data dependent at the moment.
Let's go back to David Taylor now outside the Reserve. David, you've been looking over the statement from the Reserve Bank that comes out at the same time as that decision is announced. Any clues in there about when rates may be cut, or is there any mention of a continuing tightening bias that we were talking about a few minutes ago?
Well, Ros, I think the tightening bias remains. The issue is the Reserve Bank has said in the past that it wants to be confident that inflation is going to return to the target band of between 2 and 3%. That doesn't mean the Reserve Bank needs for inflation that CPI to be between 2 and 3% before it cuts rates. It just needs to be confident that inflation is falling towards that target band. And Sherelle Murphy, before, I mean, you've got items in the basket like property prices, like rental prices, insurance premiums, out-of-pocket healthcare costs, as well as food and things like that. So higher interest rates, and we've had, don't forget, 13 interest rate increases by the Reserve Bank since, well, over the past 2 years. And the idea of that is to reduce demand in the economy, and that's doing great guns as far as that's concerned. Retail sales are pretty dismal at the moment, and you can see that reduction in demand right throughout the economy. But to get inflation to the point where the Reserve Bank is comfortable to lower interest rates and make it easier for borrowers to repay their mortgages, you need to see those other items materially come down in price, and we're just not seeing that yet. I know a lot of borrowers would like me to say that we are, but we're not. And it may not be until towards the end of the year that we do see that, and that's why many economists have on their forecast, on their radars, that we might get the first rate cut by November this year. But it could be equally as late as next year. The Reserve Bank needs to be confident that inflationary expectations aren't going to get away from them. What I mean by that simply is that if you have a situation where inflation remains too elevated, too uncomfortable for too long, that is really what's at the back of the Reserve Bank's mind. If inflation expectations remain elevated, the longer they remain elevated, the more uncomfortable the Reserve Bank is going to get. And that's where you get the other side of the argument that you could have another rate hike. So when the Reserve Bank says it could go either way, it really could, Ros, go either way.
All right, well, let's take you back to question time briefly for the Treasurer's reaction to the interest rate decision.
The Independent Reserve Bank has kept rates on hold at 4.35%, and they've pointed